Good morning. My name is David Belbin from Glenport Cummings, and I'm delighted to be joined by Julie Humphrey, who is one of our very good friends at FRP, Insolvency and Recovery Advisors, aren't you? It's a national firm of insolvency practitioners who we've been using over the years to help guide some of our clients who are having questions as to their future. And many times Julie's colleagues have come in and talked through the options with our clients, give them a few ideas, and they've gone away and can continue trading very happily. So today we're just trying to have a discussion about spotting the signs of financial distress, because as we get busier, as we come out of this terrible time of COVID, businesses are going to have all sorts of issues, from debt that they've taken on, where they've spent some of their savings that's eroded their working capital, and then they want to get going again. And so there's a few things we need to talk through. So we're going to do this as a sort of question and answer and type conversation. If you've got any questions that you want, please put them on the chat button, and we'll see those questions come up and probably pick some up. So here we go. So Julie.
Hello.
So what would you say are things our clients need to be thinking about that might suggest an early sign of financial distress as they start?
There's a question. Well, yeah, firstly, thank you for having me. Much appreciated. And as David said, just to give you a little bit background on myself personally, I've been working in insolvency for around 16 years now, qualified accountant and qualified insolvency practitioner. So I've been mainly in the corporate world, so I have been dealing with, over the last 16 years, a complete variety of businesses that have been struggling in some way, shape or form, and assessing their options and what options there are for them out there to come out of that situation. And I have come across so many different, I mean, you name it, we've seen it in terms of industry. It's one of the things that's the enjoyable aspects of my job, is coming across so many different people in different sectors. So hopefully today I can give you a bit of an insight as to what we're seeing at the moment, some things to look out for, and in answer to David's first question there, in terms of, you know, what are those early signs of financial distress? I mean, as business owners and business managers listening to this, you're going to be familiar with your businesses and what's involved in running that business. Certainly, what we're seeing at the moment is it's such a strange situation. It's completely unprecedented, to use that word that the government love to use, and there's a lot going on out there, and it's a lot of uncertainty. It's not something we've seen before, and a lot of people understandably are wondering what's coming next and what impact this is going to have in the long term. I mean, certainly what we're seeing at the moment in terms of what you need to look out for as those early signs of financial distress, it's that classic look at your profit and loss, your balance sheet, look at your cash levels, your profits. Are they declining on an operational level? Have you suddenly got some exceptional costs that have come up that you didn't have previously? Look at your KPIs, your key performance indicators. Are they deteriorating? Is there a reducing demand for what you supplied? There's many businesses out there and people listening that may well have been completely directly impacted by the impact of COVID-19, and it may have directly caused your business to have to cease trading, which is, you know, disastrous for a number of businesses out there at the moment. It might be that actually the goods or service that you provide have been able to weather this storm, and you've been able to continue trading through this period, which is fantastic news. But there may still be things out there in the wider world that is going to impact how your business operates moving forward. Have your sales declined? Have a look at your turnover figures and compare it to this time last year. There is obviously going to be significant differences now. We're in a very different world at the moment. Having a look at that order book, what work have you got coming up in the pipeline? There's a number of different symptoms here that could raise that flag of potentially having some sort of financial distress. There may be more than one. If it's just the one symptom, it might be something that can be overcome. If you're experiencing 2 or 3 of those symptoms, there might be actually something that needs to have a little bit more attention paid to it there to try and come out of that. One of the biggest things we're saying to people at the moment is cash. That's the main thing that operates your business. That's what you need on a day-to-day basis to cover your overheads and expenses. And the difficulty we're seeing at the moment is there's plenty of business owners and managers out there that have applied for the various support that the government are offering. So there's your bounce back loans and your CBILS, and that that level of support is fantastic, and it's important that we would always encourage most businesses actually to apply for those, but on a cautious basis. It's not free money. They are loans that have to be repaid, and whilst you might have applied for that and have that cash sitting in your bank account at the moment, what's really needed here is a real close look at your cash flow. You might immediately be able to meet your costs and expenses of your business at the moment, but you need to be thinking ahead to the future and how long are those cash reserves going to last. So it's really turning to having a look at what's going on within your business, both in terms of cash, the profits, the demand, your overheads and expenses, issues within your supply chain. There's just so many different factors.
Yeah, thank you very much. I mean, one of the things I've been concerned about, yes, a bounce back loan, £50,000, great, but I'm going to have to repay it. And same with the CBILS, and that's usually a much bigger amount, depending on the size of the client. It may be a small percentage of it for a larger company if you're going for the 250 with no personal guarantees. But it still needs repaying. Now, for many clients, we've seen that 250,000 that they can get from the banks because they're highly profitable or have been, is a little bit like a comfort blanket, and they won't be using it. They'll be paying it back at the end of the year before they start paying interest. But for many clients, they're going to be using it, and making sure that they know that they're going to be able to service that debt. Over the 5 years it's going to be repaid over at the interest rates that are going to be charged is important. The other worry we have is that clients have not paid they've taken the advantage of having the VAT payment holiday, and that's going to come and land by next March. And so it is really important to have a good 24 month cash flow forecast that has some sort of semblance of reality. The trouble is, as we come out, we don't know what that reality might actually look like. So it is difficult, and it needs to be capable of sort of being flexed and understood, because as you say, cash is important, and understanding what one might do to speed up the cash coming in is another part of that, isn't it?
It is, yeah, completely. And I mean, in terms of that cash flow, there's always going to be an element of sort of finger in the air and where those figures are coming from. Certainly from an overhead and expenses point of view, the majority of your clients will no doubt have a fairly good finger on the pulse as to what those look like. The question mark on any cash flow is the income, and particularly with how some businesses have been impacted at the moment, that's a little bit uncertain and difficult to forecast. But as soon as, the first starting point is looking at what cash you have, what expenses have to come out of that business over the course of the next 3 months, 6 months, 12 months. If you can forecast further than that, fantastic. And when that cash is going to run out, and that knowledge is really powerful for being able to take action within your business sooner rather than later. yes, in terms of forecasting that income, I would always say be a little bit pessimistic, be a little bit, okay, on a worst case scenario of what I think is could potentially happen here. Where does my cash run out? Where are my cash pinch points? Is there then is there a seasonal effect here? Will my turnover pick up at that point to help me through that cash pinch point, or am I going to need some more financial assistance there? If you are going to need more financial assistance in terms of those loans that we've spoken about. And it's fantastic to hear that a lot of your clients have taken the view of that is a comfort blanket and they've applied for that loan, it's the right thing to do, but they're keeping it there only if and when it's absolutely necessarily needed, because remembering that has to be repaid, and that the VAT deferral is been a fantastic help to so many businesses, but it is just a deferral. It's not a complete wipeout of that liability. That still has to be paid. So it's factoring that into the cash flow and making sure that, okay, you've had some time on your side potentially with these the government assistance, with the deferral of the VAT and the loans, to help you get through this particular situation. But can you come out of it, and can you make sure you can service that debt, as you said, David, when it becomes due and payable again?
I just feel that as we come out, clients are going to be concerned about, they have reserves, and you'd say, well, I've got money for a rainy day. Well, we are in a rainy day, but we don't know how many days we're going to have that are rainy. So are we putting good money after bad? That is a concern. On the other hand, most of our clients are, small business owners are entrepreneurs. That entrepreneurial decision, am I going to take a risk? It's knowing what the downsides are and making sure you can back up that risk.
No, completely. And a lot of the difficulty we see is there's businesses that have traded well for a number of years, and quite often especially with if it's a smaller owner managed business, the director at the top there has driven that business forward, got it to where it's got to, and is probably very passionate and cares a lot about that business. It's their baby almost, and often through no fault of anybody's, you can become a little bit blinded to some of the harsh realities that some of those businesses might be facing now. And it's difficult. It's a very difficult thing to accept that this baby that you've nurtured and grown in this business for however many years might actually be experiencing some sort of difficulty now, not necessarily through any fault of the management, but actually just external circumstances that we're seeing at the moment. And it's a difficult thing to face, and it's often the battle that we have is that challenge of an element of burying the head in the sand or throwing good money after bad. I've seen directors remortgaging homes, selling assets, just trying to plough more money into the business to plug that gap, which is all very admirable, and I appreciate you want to keep that business going. But if ultimately you sit and really look at the crux of what's going on within the business and the figures that are there, if that plugging the gap is just going to be a temporary, delaying the inevitable, and you're then left in a situation with a business that still potentially can't survive, and you're now worse off financially as well, that hasn't really helped anybody. So it's a difficult thing to face, and it's a lot to ask for you to take the sort of rose-tinted spectacles off and have a real in-depth look at your finances. But it's completely necessary. It's those, you've got that overdraft facility. Are you really tight on that facility? Are you maxing it out every month? Are you having to negotiate with suppliers on time to pay arrangements or payment plans? Is everybody on board with that? Are they going to stay on board with that? There's a lot of questions there to ask, but it is important. I mean, the main message that we say is once you can take that step to say, okay, everything might not be as rosy as I'd like it to be, let's have a really closer look at it and see where I am financially. Where is my cash going? What are the prospects of me trading out of this and getting back on track and servicing my debt? And the earlier that you do that, the more options are available to everybody, because we have this thing that we call the decline curve. And basically you have businesses at the top, that they've gone through all their growth phase, they're at a peak of trading, and then something happens. It could be the effects of COVID or something else, which is just starting to cause things to dip a little, and that's the point. It happens. There are ups and downs within every business, but that's the point. You need to take that back, sit back a little bit, have a closer look at everything, look at what's going on, and at that stage there's often a lot more options available to you. If it's kind of little bit burying your head in the sand, you see how it goes and things continually get worse and you slip down that decline curve, you get to a stage towards the bottom when actually you've missed out on the opportunity of seizing other options that could have been available to you earlier on, and actually there's very little choice left but something a little bit more final, which is not where you want your clients to be. You need to be looking at it early days, and then hopefully something can be done about it to recover.
Yeah. So unlocking asset values is something, providing you can meet the servicing requirements of that, either sale and lease back or whatever. There are options, going out and looking for invoice finance again.
Yeah.
Using the assets you've got, like debtors, and again, the invoice finance companies aren't registered charities. I haven't seen one yet, and there's a cost to it, but it does then enable, if you structure it right, it can be a way of coming out of a hole, providing that the business is going up. The time not to be doing invoice finance is when sales are diving. It's when they're growing that you should be thinking about using that as an option.
Yeah, and you I'm sure you, David, as well as us, very kind of well connected in those worlds, and would encourage your clients, if it's something they want to have a look into, to speak to you, and I'm sure you can put them in touch with a number of various invoice finance providers at different levels and different areas that can assist them with that. And it's worth the discussion, it's worth exploring, so that people have the knowledge to consider all those options available to them.
Yeah, it's just a question of talking to your trusted advisors and exploring what alternatives might be. We think about the profit and loss account, and obviously the profit and loss account will have been hit with COVID. The balance sheet inevitably is going to have been affected. We should be monitoring that balance sheet, shouldn't we? Because anybody looking at your business is going to be saying, how accurate is that balance sheet? And that's the profit and loss is the difference between two balance sheets, as I would say to a client. But the balance sheet is a key thing, because people will look at the strength of the business. And one of the issues I can see coming out of this is, if clients have had a difficult year, are they going to lose their credit insurance ratings? And is that going to impact on, or what is the impact going to be on the amount of credit that they're going to get?
Yeah, completely. I mean, there's so many things on the balance sheet to be having a closer look at. I mean, effectively, one of the tests of insolvency is looking at a balance sheet. And do you have sufficient assets to cover all of your liabilities? That's kind of the first standard test of insolvency, and it's drilling into all the figures that are on there. So, your creditor numbers and your liabilities. How are they looking? Are your trade creditors increasing faster than your business is growing? Are you under significant pressure from your creditors? Are there kind of threats of further action, of potential winding up coming from your suppliers that are becoming sort of increasingly impatient? Are there ransom creditors within that balance sheet? Are there some that could really, if they pulled the plug on the supply to you, could that really disrupt your business? Are there alternative suppliers out there in if that scenario was to happen? Having a look at your debtor days, and some of that, as David mentioned, that credit insurance may disappear, and if you have some of those bad debts those debtors on your balance sheet, then going bad, how is that really going to affect your business? It's not guaranteed that that money is going to flow in at some point. There's a number of businesses within your sectors and all sectors that will be struggling and may not actually be able to pay those debts owed to you. Have a look at those debtor days. Are they stretching? How are your debtor days interacting with your stock and your interest payments? Having a look at what stock you've got. Is that starting to go obsolete? Is it perishable? Have customers' habits changed? You know, this COVID thing has caused people to change a lot of the way they live their day-to-day lives, and that could result in the demand for your particular goods that you supply completely changing. And actually, you know, is that stock that you've got still saleable in the current environment? Or have you got to think about, actually, is that obsolete and I need to change things up a little bit? Your crown debt is very important. It's often, we see it time and time again, that in the scenarios that we come across, HMRC is always the one that's left holding the baby in a lot of scenarios. It's the first, it seems to a lot of businesses to be the first easy payment not to make. But whilst at the moment they're being relatively understanding and lenient, and there's time to pay arrangements and various discussions you can have with them to help you through this time, that's not going to last forever. There is going to come a point when they also lose patience and those historic debts need to be repaid, or they start making a formal demand there. So it's opening that dialogue sooner rather than later with them. And landlords as well is quite an interesting one. That's often another massive expense of most businesses is that rent. Are you in discussion with your landlord, trying to negotiate perhaps a reduced rent for a period of time? We are seeing quite a mixed response from landlords. There are some that are just not willing to entertain anything like that, but there are a number out there that they recognise that they want to try and help the businesses that trade from their properties, and they're willing to try and do something to help if they can, to see you come through it and they maintain a long-standing tenant, as opposed to a business that could potentially fail because of the demands that they're making. Yeah, exactly. Yeah, so it's having those discussions with them and seeing what can be done there, what can be agreed. And that's, it's often something that directors don't perhaps realise is perfectly feasible to do. They just see the debt as being due and it may not be able to be paid, and oh dear, what do I do? Just pick up the phone and explain. And what we're seeing is, if you engage with your lenders and your creditors at an earlier stage and to a certain level, if you've got that cash flow forecast, show it to them. There's nothing to hide there. Show your lenders, show the landlord, say, look, here's where I'm at with my cash, here's what I'm predicting. I've got a pinch point here, but if you can work with me, I'm hoping that come week 12, I could pay you that amount and then that amount then. And the fact that you're sort of looking at your business to that level and engaging with them and giving them that insight into where you're at will give them a lot of confidence that you're on top of the cash management within your business, and that you are looking, you haven't forgotten about the money that is owed to them, and you are looking to get them repaid in the best way that works for everybody. And there's been good responses to that. It's that level of engagement, as opposed to seeing that phone ring and thinking, oh God, that's the landlord, he's after money again, I'll ring him back later. Just deal with it head on, and you might be surprised at the reaction that you get of people wanting to help.
Yeah, we've certainly seen some clients getting a holiday or a reduction. It's the terms of, if it is a holiday, how quickly is the client going to want, or is the landlord going to want repayment of that debt, or is it going to be a reduced, is it over the rest of the term of the lease, or if you renew your lease, then it can carry on further with. If not, as well as dilapidations, you're going to have a lump sum, or are they actually going to waive some? And this kicking debt down the road can be sensible, providing it gives you time to build up some cash resource. If you've not got the cash resource, if you're not able to build the cash resource, and you've just kicked the debt down the road, one sort of wonders, and then you're going to run into a brick wall, a bit like the VAT that might have been taken. That holiday, some care and thought and planning needs to be put in place before doing that.
Yeah, exactly.
Okay. Good. So trying to forecast as we come out of these things, out of the situation we are, as sales go up, it's particularly think about our debtors. Can we work out ways of increasing the speed with which that money comes back into us at a time when everybody else is struggling? What can you do with your clients to make that work better for you?
Yeah, and analysing your credit control function. You know, a lot of businesses at this time have made use of the Furlough Scheme, which has been a fantastic help for so many businesses. But it may well be that you've had to furlough your accounts team. And is there anybody picking up the phone and chasing in those debts, or actually do you need to think about getting somebody back on that pretty sharpish? Because often it is he who shouts loudest gets answered quickest, and that's how a lot of businesses, certainly in times of distress, sort of operate. So if you've got people picking up the phone, and again, you know, it's yes, you're trying to perhaps help your clients and give them an element of understanding, an element of leeway, but obviously the number one factor for you is you and your cash flow and your business, and those debts are due and payable. And particularly if you've got clients that haven't been directly impacted by COVID, you know, there isn't any real reason why they shouldn't be able to meet those debts as and when they're due, and not use this scenario as an excuse not to pay.
Yep. Okay. Right. Let's cut to the chase. I've done some work on my accounts. I really can't see myself getting out of the hole that I am now because I've got some debts. I could see the business being capable of working forward, but it's saddled with a load of debt. What are the sort of options that I could be looking at?
Yeah, well, I mean, there are a lot of options out there which many people won't necessarily be aware of. I mean, in terms of, first and foremost, how much have you had a look into your business? Have you cut your overheads as much as you can do? The working from home situation that many people have had to adopt now, is that something you can actually take forward, even when if it's not necessary in the future, but actually if that works, you can cut a lot of your fixed overheads in doing that. Have you explored all those options? If you've gone through all of those options and actually you're thinking, okay, this isn't really going to work, I need to do something a little bit more formal. There are plenty of options out there. So number one is have that cash flow and negotiate with the people you owe money to, the people that are coming due and payable soon, your lenders, banks, invoice finance providers, HMRC, key suppliers that you often, these businesses or as management would have long-standing relationships with their suppliers. Use that to your advantage. You've traded well with them for the last 8 years. That counts for a hell of a lot. Have those discussions with them. Can they help you out here? So that would always be my recommendation for your kind of first port of call. If you've gone through that and actually things are still looking a little bit iffy, you can consider, and this is where we'd always encourage, is that communication. Speak to David, speak to your accountant, get their input. Speak to someone like us. We advise clients all the time. We have someone come in, we speak to anybody free of charge. We have an initial meeting, either face-to-face or over the phone, and have a real sort of outsider's assessment of your business and where it's at without any of the emotions attached to it. And consider your options for you. Now, for us, the ideal situation is that we can come to some solution that doesn't need to actually formally engage us or have us involved, and you can just do a few things and get back on track, and that way your business stays up and running. We've done the right thing in advising you as a client of David's, and that's the ideal scenario that we're looking for. If actually that doesn't look like there's going to be an option there and you need something more formal, there's a variety of processes that you can go through. So starting with potentially a CVA, it's a company voluntary arrangement. There's been a bit of press about these. People may have come across them before, you may not have heard of them. And all that basically is a more formalised arrangement with your creditors. So you would engage somebody like us, we would draft together proposals for you, and those proposals would be sent out to all the creditors that you owe money to at that point in time. And it would be saying, look, here's the business, here's what's happened, here's where things have gone a little bit wrong, here's what we're proposing to do to kind of restructure, reduce our overheads, make sure, you have to prepare a cash flow forecast to go with that, to say, look, here's what we're forecasting. With the changes we're going to implement, we believe that we could pay X amount a month into a pot for creditors, and that would normally last a period of sort of 3 to 5 years. And it would be you paying an amount out of your monthly profits into a pot. All the creditors bound by the CVA at that time can't take any other sort of action against the company. They're bound by that CVA, and as long as you're adhering to the terms of it and making those monthly payments to us as supervisors, we babysit that pot of money, and after a couple of years we'll start distributing that money out to the people that you owe money to. And it might be that you can do that over 3 or 5 years and offer 100 pence in the pound back to each creditor. It might be that you need to compromise that debt a bit, and actually the best proposal I can come up with is that you get 60 pence in the pound back on your debt. But often it's pointed out to people that, look, I'm in a bit of a tricky situation here. If this doesn't go through and this isn't approved, the alternative could be a complete shutdown, and in which case it might be unlikely that you'd get anything back. So often, creditors are on board with recognising that, albeit it's going to take them longer to get their money than they'd hoped. But at least it's a way of business owners demonstrating that you're trying to do the best you can to work with your business as it is and pay everybody back as much as you can afford to. So that's certainly an option to consider. Failing that, you may actually have just too much debt in your business that wouldn't work, and you can't come up with, that the future trading is too uncertain to be able to come up with sufficient cash flows to demonstrate that you can make those monthly payments and pay people back. So there are other options out there in terms of administration or liquidation. But if you've got a viable business there, but the debts have just become have mounted to such a level that it's just not possible to trade and service those, but actually there is a viable business there, then there are ways and means of potentially purchasing that business back through perhaps a pre-pack administration process or through a CVL process if it's kind of a smaller situation. And there's nothing wrong in doing that. It's often a bit of an unknown that people think there's some kind of wrongdoing going on there. As directors of businesses, you have done the best you can in managing that business through circumstances that aren't your fault. You found yourself in this situation, and actually you've still got to earn an income and have have income going forward, and there is a viable business there. So it's perfectly legitimate to actually this limited company as it stands just has too much debt within it, set up a new limited company, and you can purchase the assets of that business and then continue trading with almost a clean slate. It's a difficult thing to get your head around and not something, a decision that's taken lightly, but sometimes it's necessary. And people are often a lot more understanding, particularly, those suppliers that know you well. They know that you've done your best, you've done what you can, and through no fault of your own, you've just found yourself in this circumstance. And in that scenario, the liabilities would remain with the liquidator or the administrator, and the money that's paid for the assets, and that's just at market value. An independent agent values it, and an amount is paid for those assets, and it's all perfectly legitimate. If your business ceased trading and us as liquidators or administrators had to sell your assets, we'd only get whatever market value you can get for it, and as long as what you pay for that is a market value, then you have that clean slate and it's fully justifiable. And we then realise the assets, we take that pot of money and distribute it out to the creditors that you owe money to. It might be that they don't see much money back from that scenario. It might be that they get a small dividend back, and the only thing to kind of be aware of there is, there will be an element of directors' conduct being reviewed as part of a process like that. But I mean, in this scenario, there's very few directors out there that, unless you've just taken a sea bill and gone and bought yourself a nice yacht off the south of France somewhere for a rainy day, then there aren't going to be too many issues there to be concerned about. So that's certainly an option. And then if actually where we see ourselves now in the economy, your business just, there isn't a market for it anymore, full stop, which may be the case for some people, then it may be a case of just shutting that business down. And it's something that we can help with. It sounds very daunting and scary, but it can be, our role is to make it as painless as possible for you and to take as much of that pain off of you as as we can to get you through it quickly, and on the other side so you can move forward with your next venture. So there are a number of options out there. Similarly, it may be that your business isn't actually insolvent. You may be quite asset rich, but actually the business just isn't there to continue trading. You kind
I was
of
going
think,
to ask that question, because
was
there
you?
will
Sorry.
be no, that's fine. There's many clients who are thinking, okay, I don't want to put good money after bad. I've got assets in the company, I might have some property or whatever, but I can't see a sensible way forward. I'm that time of life, I may want to retire and stop. And it's about how you stop the business in a graceful way, in a tax efficient way, a solvent liquidation or whatever. And the rules on that have changed. Well, they changed about 5 or 6 years ago, didn't they? But
I
so
did, yes.
in the good old days, I used to be able to close down companies that had loads of cash in, but I can't do that anymore. I have to rely on our good friends FRP or whoever, because it needs a licensed insolvency practitioner if assets are in excess of £25,000, doesn't it?
It does, yes, yeah. And again, it's a lot of businesses, including us, have taken that step further into remote working, electronic signing. So a lot of these processes, they don't involve extensive meetings and drawn out processes. They can be done quite quickly. And it's with a solvent liquidation, it's a relatively straightforward scenario of pay off all your creditors, everyone that's owed money, get your tax affairs up to date, all your returns filed, any outstanding tax paid to HMRC, and then we can just, through quite a swift process, prepare the documents to place that company into it's called a members voluntary liquidation. And all we look to do is extract the value from the business, be it cash or physical assets, whatever it might be, a director's loan account, something like that, and distribute it back to the shareholders of the business in the most tax efficient way, as you said, David. And that process can happen quite quickly. Once you start that liquidation process, you can have the majority of the funds in your pocket within the space of potentially a couple of weeks. And then after we have to allow a period of time in case there's any creditors that come out the woodwork, so we have to ask HMRC to say yes, it's fine, they've paid all their tax and you can go ahead and close this company. And unfortunately HMRC can take a number of months sometimes just to confirm that to us, but once they've confirmed that, it all closes down and the business is eventually dissolved, and you've extracted the value out in the most tax efficient way possible.
Yeah, because Entrepreneurs Relief is still available up to £1 million, and
it is, yeah.
It's an alternative. So,
yeah.
Okay, you touched on it earlier, just very quickly. Directors' responsibilities if they are trading when they shouldn't be. What can be done to them? This is not putting good money after bad. This is doing stuff that they probably shouldn't be doing.
Yes,
this is trading when you shouldn't be trading, isn't it?
It is, yeah. And there's, we're seeing a lot of activity at the moment. There's other things going on out there. We have come across people that are completely sort of abusing and misusing the furlough scheme to start off with. If you're furloughing staff but actually they're still working, or you have no real intention of taking them back on, they're going to be made redundant, that is something that could potentially be looked into later down the line, particularly if your business ends up failing. And I've heard actually HMRC, there's a maximum penalty of that of up to 10 years in prison. I'm not sure that's real kind of severe cases, but it's just something to be aware of, that it is something that they will be looking to police a lot closer in the coming months. And the use of the loans as well, bounce back loans and C-bills. It's not an opportunity to grab the money and buy yourself a nice Ferrari or pay off your mortgage. That's not what they're designed to do. And whilst at the moment the magnifying glass might not be on too closely at what's happening with those monies, the banks and the lenders certainly will be taking a closer look, and particularly again if you do then subsequently fail with the business, it is something that will be looked into. Now I know that it has been reported that the wrongful trading provisions have been suspended. So wrongful trading is, as David said, trading when you are insolvent and you go past that point when you should have, as a director in your fiduciary duty, you should have recognised that the business is insolvent and actually shouldn't carry on trading. And if you continue past that point for too long, and actually all you're doing is worsening the position within the business and you're increasing those liabilities to creditors, if the business subsequently then fails, what wrongful trading does is it prompts a liquidator to have a look at the director's conduct and say, actually, you should have really known, you should have ceased trading back then, and as a result the position has got X amount of pounds worse, and you could find yourself personally liable for that worsened position. Now, the provisions have been suspended in light of COVID, but that doesn't mean that it's okay to then do that. There are other claims that can always be made against directors in that scenario. The Department for Business and Industrial Strategy, it changed its name, it used to be the DTI, but that they can review a director's conduct in that scenario and consider, are they fit to be a director actually? Should they be disqualified from being a director for a number of years? That is something they can look at. Then there are other claims, there's still misfeasance, there's fraudulent trading, there's things to be aware of that you could be doing without necessarily realising, and at the point that a business fails and that situation crystallises, you could find yourself being personally liable for a lot of the company's debts, or certainly how much it's worsened over that period of time. So it is something to be aware of. It happens. You might just think, actually, I can trade out of this, and with the best of intentions, but just be mindful that if you're at that point when you think, if I'm really honest here, I am past the point of return and something needs to happen, there is potential for personal liability on you as a director, and your fiduciary duty to take the appropriate action at the right time. And the other thing just to consider is the mental health aspect as well of what's going on with COVID at the moment, and your staff. And yourselves, there's a lot happening out there, and it is impacting a number of people in different ways. So it's just being mindful of that, recognising that, and offering as much support as you can do to your staff, as you feasibly can within the business, to help them and know that they have that support there, and if they are struggling, to seek the appropriate help.
Thank you very much. Now, I'm looking to see if there's any questions. I'm thinking you've covered very kindly. You've covered all the areas that I've wanted to sort of try and pick up on. It is uncertain times, isn't it? But I think the main takeaway is actually talk to people, talk to your advisors, talk to your creditors, talk to your debtors, talk to your bankers, but talk. Don't leave it to the last minute.
Exactly, that is the overriding message here. Talk and focus on that cash management. Cash is king, that old phrase. And have a look. Are you getting good management information? Do you have clear visibility on where your business is and where it's going on a financial basis? It's just absolutely imperative.
And we can do that. We can do interim accounts, and that's really useful if you're just concerned. So it's that sort of thing we can do. Don't have to wait to year end to do your accounts at all.
No, exactly.
Right. So can I just take this opportunity to thank you very much for joining us, and we'll see you again soon.
Excellent.
When we're allowed to see each other properly. It'd be nice.
Yes, hopefully.
Okay.
Yes,
Thank you very much.
Thank you very much for having me.
Thank you.
Thank
Bye-bye.
you. Bye.
Bye.